Welcome to our comprehensive guide on corporate governance. In this video, we'll break down the essentials of the Corporate Governance Code, focusing on mandatory requirements, guiding principles, and best practices. Whether you're a board member, executive, or investor, understanding these standards is crucial for building trust, transparency, and long-term value. Let's start by exploring what corporate governance really means and why it's so important for modern organizations. We'll also touch on how these principles support sustainable growth and stakeholder confidence. First part of the Corporate Governance Code outlines mandatory disclosure requirements. Every issuer must include a detailed corporate governance report in their annual and summary financial reports. This report ensures transparency and accountability, providing shareholders with the information they need to evaluate how governance principles are being applied. Failing to meet these disclosure requirements is considered a breach of the exchange listing rules, highlighting the seriousness of compliance. The report should be clear, unambiguous, and include both compliance statements and explanations for any deviations. When issuers prepare summary financial reports, they can include a summarized version of the full corporate governance report. However, this summary must not simply reference the full report. It should provide a narrative statement about overall compliance and highlight any deviations. The summary should help shareholders quickly understand the company's governance stance, making it easier to spot areas of compliance and concern. Clear references and explanations are essential to avoid confusion and maintain transparency. Code's second part introduces the principles of good corporate governance, along with code provisions and recommended best practices. These principles set the overall direction for effective governance, while the code provisions help issuers apply them in practice. Importantly, the code recognizes that one size does not fit all. Companies can achieve the spirit of the principles through different means, depending on their size, complexity, and unique challenges. Flexibility is encouraged, but any deviation from the code provisions must be explained. Recommended best practices in the code are voluntary but highly encouraged. They serve as guidance to help issuers strengthen their governance frameworks and support the application of core principles. While not mandatory, issuers are expected to state whether they follow these practices and provide reasons for any deviations. This approach fosters a culture of continuous improvement and transparency, encouraging companies to go beyond the minimum requirements for the benefit of all stakeholders. Key feature of the code is the comply or explain approach. Issuers must state in their reports whether they have complied with each code provision. If not, they must clearly explain the reasons for any deviation and describe alternative actions taken to achieve good governance. This explanation should be detailed, providing shareholders with the rationale and outcomes of the alternative approach. The goal is to foster constructive dialogue between issuers and shareholders, promoting continuous governance improvement. Shareholders play a vital role in corporate governance. The code encourages shareholders to engage constructively with issuers, especially when deviations from code provisions occur. By evaluating the explanations provided, shareholders can better understand the company's unique circumstances and contribute to informed discussions. This engagement helps drive continuous improvement and ensures that governance practices remain relevant and effective. Corporate governance and environmental, social, and governance (ESG) considerations are closely linked. Good governance provides the framework for boards to make decisions that support long-term sustainable growth and value creation for all stakeholders. Effective governance structures help issuers identify, evaluate, and manage both environmental and social risks and opportunities. Boards are responsible for overseeing ESG matters and ensuring that material risks are disclosed in ESG reports, as required by the ESG Reporting Code. Transparency is a cornerstone of effective corporate governance. Issuers must provide detailed information in their annual reports, covering the entire accounting period and any significant events up to the publication date. This includes narrative statements on governance practices, compliance with code provisions, and explanations for any deviations. Such transparency builds trust with shareholders and other stakeholders, ensuring that everyone has access to the information needed to make informed decisions. A well-composed board is essential for effective governance. The code requires issuers to disclose the composition of the board, including the names and categories of directors, such as chairman, executive directors, non-executive directors, and independent non-executive directors. Information on board meetings, attendance, and the responsibilities of both the board and management must also be included. This transparency helps shareholders assess the board's effectiveness and independence. It's important to clearly identify the roles of the chairman and chief executive. The code requires issuers to disclose the identity of both, ensuring there is a clear division of responsibilities. This separation helps maintain a balance of power and prevents any one individual from having excessive authority. Clear role definitions support effective leadership and accountability at the highest level of the organization. Non-executive directors play a critical role in providing independent judgment and oversight. Issuers must disclose the terms of appointment for non-executive directors, ensuring transparency about their tenure and independence. This information helps shareholders evaluate whether the board has a strong independent element and whether non-executive directors are able to carry out their duties effectively. Board committees are essential for handling specific governance functions. The code requires issuers to disclose information about each committee, including their roles, composition, meeting frequency, and attendance records. Committees such as audit, remuneration, nomination, and risk play specialized roles in overseeing key areas like financial reporting, director remuneration, and risk management. Transparency about committee activities ensures accountability and effective oversight. Audit committee is responsible for reviewing financial results, risk management, and internal controls. It must report on how it meets these responsibilities, including any noncompliance and remedial steps taken. The committee also oversees the effectiveness of the internal audit function and ensures that the company's financial reporting is accurate and reliable. Detailed reporting by the audit committee builds confidence among shareholders and regulators. Remuneration committee determines policies for executive pay, assesses performance, and approves service contracts. It also reviews matters related to share schemes and ensures that no director is involved in setting their own remuneration. The committee's work is crucial for attracting and retaining talent while maintaining fairness and transparency. Disclosure of its activities helps shareholders understand how executive compensation is managed. Nomination committee is tasked with identifying qualified candidates for board positions, assessing director independence, and making recommendations for appointments and succession planning. It must disclose its policies and procedures for nominating directors, ensuring that the board remains diverse, skilled, and effective. This transparency supports orderly succession and board renewal. A risk committee exists. It is responsible for reviewing the company's risk management and internal control systems. The committee ensures that risks are identified, evaluated, and managed effectively, and that the internal audit function is robust. Reporting by the risk committee helps shareholders understand how the company is addressing key risks and maintaining operational resilience. Corporate Governance Committee, or the board itself, is responsible for developing and reviewing governance policies and practices. It ensures compliance with the Corporate Governance Code and oversees the company's overall governance framework. Regular review and disclosure of governance activities demonstrate the company's commitment to high standards and continuous improvement. Company Secretary plays a vital role in supporting the board, ensuring good information flow and advising on governance matters. If an external service provider is engaged, the issuer must disclose the primary corporate contact person. The company secretary also facilitates director induction and professional development, helping the board stay informed and effective. Issuers must adopt a code of conduct for directors' securities transactions that meets or exceeds the standards set out in the model code. They must also confirm whether directors have complied with these standards and disclose any noncompliance, along with remedial actions taken. This ensures integrity and prevents conflicts of interest in securities dealings. Effective risk management and internal control systems are essential for safeguarding assets and ensuring reliable financial reporting. Issuers must disclose whether they have an internal audit function, how often systems are reviewed, and whether they consider their controls effective. These disclosures help stakeholders assess the company's risk management capabilities. Transparency in auditor remuneration is important for maintaining trust. Issuers must provide an analysis of fees paid for audit and non-audit services, including the nature of each significant non-audit assignment. This helps shareholders evaluate the independence and objectivity of the external auditor. Diversity on the board is crucial for balanced decision-making. Issuers must disclose their board diversity policy, including measurable objectives and progress. They should also explain how and when gender diversity will be achieved, set numerical targets and timelines, and describe measures to develop a pipeline of diverse candidates. This commitment to diversity supports innovation and better governance. Beyond the board, issuers must disclose the gender ratio in their workforce, including senior management. They should outline plans or objectives for achieving gender diversity and explain any challenges or mitigating factors. This transparency helps stakeholders understand the company's approach to inclusion and equality. Protecting shareholders' rights is a key aspect of governance. Issuers must explain how shareholders can convene extraordinary general meetings, submit inquiries to the board, and put forward proposals at meetings. Providing clear procedures and contact details ensures that shareholders can actively participate in the company's decision-making process. Strong investor relations are built on open communication. Issuers must disclose any significant changes to constitutional documents, outline their shareholder communication policy, and review its effectiveness annually. This ensures that shareholders' views are heard and considered in the company's strategic decisions. The board is responsible for setting the company's purpose, values, and strategy. Directors must act with integrity, lead by example, and promote a culture of ethical and responsible behavior. The annual report should include a discussion of the group's performance, business model, and long-term strategy. This focus on long-term value creation helps align the company's actions with stakeholder interests. The board is ultimately responsible for corporate governance duties, though it may delegate these to committees. Key responsibilities include developing and reviewing governance policies, monitoring director training, ensuring compliance with laws and regulations, and overseeing the code of conduct. Regular review and disclosure of these activities are essential for maintaining high governance standards. Balanced board combines skills, experience, and diverse perspectives. The code requires a mix of executive and non-executive directors, with a strong independent element. Regular reviews of board diversity and mechanisms for independent input are essential. The board should also conduct regular performance evaluations and explain any cross-directorships or significant links among directors. Appointing new directors should follow a formal, transparent process. All directors are subject to re-election at regular intervals, and issuers must explain any resignations or removals. For independent non-executive directors serving over 9 years, special resolutions and detailed justifications are required. This ensures orderly succession and maintains board independence. Nomination committee reviews board structure, identifies qualified candidates, assesses independence, and recommends appointments. It must have clear terms of reference and sufficient resources to perform its duties. When proposing new independent directors, the committee should explain the selection process, the candidates' qualifications, and how they contribute to board diversity. Directors must always be aware of their responsibilities, including legal and regulatory obligations. Newly appointed directors should receive comprehensive induction and ongoing professional development. Non-executive directors are expected to provide independent judgment, participate in committees, and scrutinize company performance. Continuous learning ensures directors remain effective and informed. Board must clearly define which matters are reserved for its approval and which are delegated to management. Delegation arrangements should be formalized and reviewed regularly. Directors should understand these arrangements, and formal letters of appointment should set out key terms and conditions. This clarity supports effective decision-making and accountability. Board committees must have clear terms of reference that outline their authority and duties. They should report back to the board on their decisions and recommendations unless restricted by legal or regulatory requirements. This ensures that the board remains informed and can provide effective oversight of committee activities. Regular board meetings are essential for effective governance. The code requires at least 4 meetings per year, with proper notice and opportunities for directors to add agenda items. Minutes must be kept in detail and made available for inspection. Directors should have access to all relevant materials and be able to seek independent professional advice when needed. When conflicts of interest arise, especially those involving substantial shareholders or directors, the matter should be addressed at a physical board meeting with independent non-executive directors present. This approach ensures transparency and that decisions are made in the best interests of the company and its stakeholders. The company secretary ensures good information flow within the board and that procedures are followed. They report to the chairman or chief executive and facilitate director induction and development. All directors should have access to the company secretary's advice and services, supporting effective governance and compliance. Board must present a balanced, clear, and comprehensible assessment of the company's performance, position, and prospects. Management should provide sufficient information for informed decision-making, and directors must acknowledge their responsibility for preparing accounts. Transparency in financial reporting builds trust with investors and regulators. Board is responsible for evaluating and determining the nature and extent of risks in achieving strategic objectives. This includes overseeing risk management and internal control systems, with annual reviews covering all material controls. The board must disclose how these systems are managed and their effectiveness, especially regarding ESG risks. Issuers should have an internal audit function or review the need for one annually. They must also establish whistleblowing policies and anti-corruption systems, allowing employees and stakeholders to raise concerns confidentially. These measures support ethical conduct and help identify potential issues early. Audit committee must have clear terms of reference, keep detailed minutes, and ensure no former audit firm partners serve as members within 2 years of leaving the firm. The committee oversees auditor independence, reviews financial statements, and monitors internal controls. Sufficient resources must be provided for the committee to perform its duties effectively. Formal and transparent policy on directors and senior management remuneration is essential. The Remuneration Committee should consult with the chairman or chief executive, review pay proposals, and ensure no director is involved in setting their own remuneration. Disclosure of remuneration policies and details in annual reports promotes fairness and accountability. Ongoing dialogue with shareholders is vital. The board should use annual and general meetings to communicate with shareholders and encourage participation. Issuers should have a dividend policy and disclose it in their annual report. Effective engagement ensures that shareholders' views are considered in strategic decisions. Corporate governance is not static. It requires continuous review and improvement. Issuers are encouraged to regularly evaluate their governance practices, disclose any significant concerns, and adapt to new challenges. By fostering a culture of transparency, accountability, and ethical leadership, companies can build long-term value for all stakeholders. Sum up: effective corporate governance is the foundation for sustainable business success. By following the corporate governance code, embracing transparency, and engaging with stakeholders, companies can build trust and resilience. Remember, good governance is a journey. Continuous improvement and open communication are key. Thank you for joining us on this deep dive into corporate governance essentials. Stay informed, stay compliant, and drive positive change in your organization.